We have been conditioned to accept a fundamental multi-trillion-dollar miscalculation about what it actually means to be wealthy in America. You are relentlessly taught to obsess over a single, ever-growing number on a screen, sacrificing your prime decades to feed a retirement account that you might not even possess the physical vitality to enjoy by the time you are legally allowed to touch it. But true financial independence is absolutely not measured by the sheer size of your capital stockpile. It is measured entirely by your immediate, unconditional power to say no. Welcome to the reality check. For the last 40 years, the American financial services industry has sold you the myth of accumulation. It is a very simple, very profitable narrative. It goes exactly like this. Go to school, secure a salaried position, buy the absolute largest house a bank will underwrite, and systematically funnel every spare dollar into tax-advantaged accounts like a 401k or a Roth IRA. The goal, they confidently tell you, is to build a massive mountain of money so that one day, at age 65 or perhaps 67, you can finally step off the treadmill and start living your actual life. But let us look objectively at the economic landscape of 2026. We are operating in an environment fundamentally altered from the golden era of the 1990s or even the immediate post-2008 recovery. The traditional blueprint was written for a time that no longer exists. Back then, defined benefit pensions still existed in the private sector. Healthcare costs did not consume a double-digit percentage of a middle-class household's gross income. Today, we face the systemic erosion of our purchasing power through stubborn inflation residue, climbing property taxes, and structural shifts in the labor market that make a 30-year career at a single corporation a statistical anomaly. In this modern environment, obsessing solely over net worth accumulation creates a very specific, invisible trap. You end up wealthy on paper, but completely impoverished in terms of time, leverage, and choices. Wall Street institutions love the accumulation model. They thrive on it. Why? Because the entire wealth management industry is built on assets under management. They extract their 1% or 1.5% in hidden mutual fund fees year after year off the total size of your pile. They do not profit when you gain control over your time. They profit when your capital is locked away, entirely illiquid, and totally dependent on market cycles that you cannot control. To really understand the danger of the accumulation mindset, let's examine the lives of a hypothetical couple. We'll call them Mark and Sarah. They're 52 years old, living in a nice manicured suburb outside of Dallas, Texas. Between Mark's role as a regional logistics director and Sarah's income as a healthcare administrator, they're grossing a very respectable $180,000 a year. By every traditional metric peddled by mainstream financial media, Mark and Sarah are winning the game. Their combined 401k and IRA balances just crossed the $900,000 mark. Their home is currently appraised at $650,000. Their net worth is well over $1 million. They are officially millionaires. But let us strip away the vanity metrics and look at their actual day-to-day reality. Mark and Sarah are carrying a $400,000 mortgage at a modern interest rate. They have 2 substantial auto loans for vehicles they use primarily to commute to the jobs they are exhausted by. They're cash flowing their eldest daughter's out-of-state university tuition, and their property taxes and insurance premiums have surged 30% over the last 4 years. Here's the brutal truth about Mark and Sarah's so-called wealth. If Mark's division is restructured next week and he loses his job, the clock starts ticking immediately. Despite having nearly $1 million in the stock market, that money is entirely walled off behind early withdrawal penalties and aggressive IRS tax triggers. They have exactly 3 months of liquid emergency funds before they face a catastrophic liquidity crisis. They can't downsize their lifestyle quickly enough to stop the bleeding. Mark will be forced to take the very first job he is offered, even if it requires a grueling commute, pays 20% less, and destroys his mental health, simply to service the fixed overhead of their wealthy life. Mark and Sarah have massive accumulation, but they have absolutely zero optionality. They are highly paid indentured servants to their own balance sheet. Now, contrast them with another hypothetical American. Let's look at Linda, Linda is 58, living in a modest, older neighborhood in Columbus, Ohio. She never earned a massive six-figure salary. For most of her career as an independent graphic designer, she brought in around $70,000 a year. Her total investment portfolio sits at a comparatively modest $400,000. The Wall Street establishment would look at Linda's accumulation and tell her she's drastically behind, that she needs to take on more risk, work significantly harder, and delay her retirement. But Linda played a completely different game. 10 years ago, she intentionally stopped upgrading her lifestyle. She aggressively paid off her 3-bedroom home. She drives a perfectly reliable 8-year-old sedan with absolutely no car payment. And over the years, she purposefully built a portfolio focused on immediate cash flow rather than distant speculative growth. Between a ladder of high-yield treasury bonds, some strategic dividend-paying index funds, and renting out her finished basement to a traveling nurse, Linda generates about $2,000 a month in purely passive, unearned income. Her baseline living expenses, because she carries absolutely no debt, are only $2,200 a month. Linda is essentially financially bulletproof right now. She doesn't need to wait until she's 65. If she loses a major client tomorrow, she doesn't panic. If she decides she wants to take a 3-month sabbatical to help raise her new grandchild, she simply goes. She has complete leverage over her own time. Linda has half the accumulation of Mark and Sarah, but she possesses infinite optionality. This is the profound difference that traditional financial advice aggressively ignores. Optionality is the margin between your unearned income and your baseline survival cost. It's the ability to walk away from a toxic boss. It's the power to weather a severe market correction without losing a single night of sleep. It's the ultimate luxury of waking up on a Tuesday morning and realizing that your time belongs entirely to you. When you measure wealth strictly by accumulation, you're essentially betting your current life for a deferred payout that is entirely dependent on future macroeconomic conditions. You're assuming the tax code will remain favorable. You're assuming inflation will not decimate the purchasing power of your nest egg. You're assuming your health will hold out perfectly until the finish line. That's an incredibly fragile way to design a life.
Let us tear away the emotional comfort blanket and look directly at the cold, unforgiving mathematics of this accumulation illusion. If you want to understand why a massive net worth does not automatically translate into a stress-free life, you have to realize that the number you see when you log into your brokerage account is a mirage. It is a gross number, not a net number. And standing between that gross accumulation and your actual purchasing power are 3 silent, relentless partners: Wall Street, the Internal Revenue Service, and the Federal Reserve. Let us start with the wealth management industry and the insidious mathematics of the assets under management model. Most hardworking Americans are bleeding capital and they don't even realize it because the wound is hidden in the fine print. Let us look at a hypothetical investor. We'll call him Robert, a 48-year-old structural engineer living in Colorado. Robert has been diligent. He has managed to accumulate $500,000 in a portfolio of actively managed mutual funds through his financial advisor. His advisor charges what sounds like a completely harmless fee, a standard 1% annual management fee. On top of that, the mutual funds themselves have an internal expense ratio of 0.75%. That's a total drag of 1.75% every single year. Wall Street convinces you that 1.75% is just a tiny sliver, a rounding error. But let us do the painstaking math on Robert's money over the next 20 years, assuming he never adds another dime and the market returns a standard 7% annually. Without those fees, Robert's $500,000 would compound to about $1.9 million by the time he's 68. But with that 1.75% systemic erosion, his net return drops to 5.25%. After 2 decades, Robert's portfolio will only grow to $1.3 million. That tiny, supposedly harmless fee did not just cost Robert a few $1,000s, it siphoned off $600,000 of his wealth. That's more than his original starting balance. That's over $600,000 transferred directly from Robert's family to pay for a wealth manager's corporate retreat, simply because Robert chose accumulation over efficiency. When you calculate how many actual hours of his finite human life Robert spent working in a cubicle just to generate that $600,000 for Wall Street, the reality is entirely sobering. But Wall Street is only the first silent partner. We must confront the reality of the Internal Revenue Service. The vast majority of American accumulation is sitting inside tax-deferred vehicles, traditional 401ks and standard IRAs. Financial media praises this as brilliant tax avoidance. It is not tax avoidance. It is tax postponement. When you defer your taxes, you're entering into a binding, long-term joint venture with the United States government, but you're allowing the government to decide their ownership percentage decades after you sign the contract. Look objectively at the current fiscal trajectory. We are operating with a national debt that defies historical precedent. Does simple mathematical logic suggest that federal income tax rates will be lower or higher in the 2030s and 2040s? If you have managed to hoard $2 million in a 401k, you don't actually have $2 million. If you're forced to draw down $100,000 a year to fund your life and effective tax brackets adjust upwards to manage sovereign debt, you might only net $70,000. Your massive accumulation is fundamentally a hostage to future legislative tax policy. That is not financial independence. That is extreme legislative vulnerability. And finally, we have to factor in the Federal Reserve and the deeply destructive math of systemic inflation. We are conditioned to cheer when our homes and our portfolios go up in value, but we routinely fail to distinguish between nominal growth and real purchasing power adjusted growth. If your portfolio grew by 8% last year, but the true cost of your property taxes, your healthcare premiums, your auto insurance, and your baseline groceries inflated by 6%, your real wealth only expanded by 2%. When you base your entire life strategy on a distant accumulation target, say the classic $2 million retirement goal, you're aiming at a moving target. The $2 million you projected 10 years ago will simply not buy the same lifestyle 10 years from now. If inflation averages even a moderate 3.5%, the purchasing power of your money is cut entirely in half every 20 years. That means your $2 million accumulation might only feel like $1 million in today's money by the time you actually unlock it. You are running on a treadmill that is quietly accelerating. You're taking on all the market volatility, paying all the hidden fees, and carrying all the future tax risk just to tread water against the central bank's currency devaluation. This is why standard accumulation is a fundamentally flawed metric. It requires absolute perfection across variables you cannot control. Zero market corrections right before you retire, stagnant tax brackets, and permanently low inflation. If even one of those variables shifts, which historical data guarantees they will, the entire mathematical foundation of the accumulation strategy fractures.
We must now confront the most uncomfortable question in this entire equation. Why highly intelligent, rigorously educated Americans continually walk directly into this trap. We are talking about engineers, physicians, corporate directors, and small business owners. These are individuals who manage complex logistics, perform surgeries, and navigate intricate legal frameworks every single day. Yet, when it comes to their own balance sheets, they completely abandon analytical logic and surrender to a deeply flawed psychological script. To understand this paradox, you have to dissect the machinery of modern American consumerism and the financial media complex. You are fundamentally not dealing with a failure of intelligence. You're dealing with a heavily engineered environment designed to extract your capital by manipulating your deeply rooted human instincts. The financial networks, the glossy magazines, and the algorithmic feeds do not exist to educate you. They exist to manufacture discontent. They sell a potent blend of anxiety and aspiration disguised as financial insight. Let us look at how this plays out in the real world by examining another hypothetical case study. Consider David and Alina, a couple in their mid-40s living in the affluent Chicago suburb of Evanston. David is a senior partner at a corporate law firm, and Alina is a marketing executive. Combined, they are generating an astonishing $350,000 in gross annual income. By any historical standard, David and Alina are in the top tier of global earners. They should be absolutely bulletproof. Instead, they are silently suffocating under a mountain of lifestyle overhead. Why? Because of a psychological vulnerability called the expectation baseline. When David made junior partner, the unspoken social contract of his peer group mandated an upgrade. The perfectly functional Honda Accord was no longer socially acceptable in the firm's parking garage. It was replaced by a $90,000 imported luxury SUV. They upgraded from a comfortable $400,000 home to a $1.2 million estate, not because they needed the square footage, but because their zip code acts as a proxy for professional success. Let us do the painstaking math on just one of these psychological missteps, the $90,000 luxury vehicle. David justifies this purchase by saying he works 80-hour weeks and he deserves a nice ride, but he's entirely ignoring the gross to net reality. To afford a $90,000 vehicle, David doesn't just need $90,000. Because he sits in a combined federal and state tax bracket of roughly 37%, he actually has to generate over $142,000 in raw pre-tax corporate billing just to clear the capital to buy the car in cash. But David did not buy it in cash. Like most Americans, he financed it. At a modern auto loan rate of 7.5% over 60 months, that vehicle will ultimately cost him around $108,000 out of pocket. That means David must earn roughly $170,000 in gross income to acquire a depreciating piece of metal that will be worth less than $40,000 in 5 years. If we divide that $170,000 by his hourly billing rate, we can calculate exactly how many hundreds of hours of his finite, unrecoverable human life he traded away simply to impress colleagues who are secretly drowning in the exact same debt. That is not a reward for hard work. That is an act of financial self-sabotage driven purely by ego. This is the psychological autopsy of the modern middle and upper middle class. In the 1990s, keeping up with the Joneses meant looking at your immediate physical neighbors. Today, because of digital connectivity, you are subconsciously comparing your behind-the-scenes reality to the heavily curated, debt-fueled highlight reels of millions of strangers across the globe. The fear of missing out, the pervasive FOMO, convinces you that if you are not constantly upgrading your kitchen, taking European vacations, and driving the latest model year, you are somehow failing at life. You'll often hear people push back against this reality. They will say, "But I need to live a little. I could get hit by a bus tomorrow. I'm not going to eat rice and beans and hoard every penny just so I can be the richest guy in the graveyard." This is a classic cognitive defense mechanism. It presents a false binary choice. The wealth management industry and the marketing agencies want you to believe that your only two options are either absolute miserable deprivation or reckless maximum consumption. But that's a lie. Building optionality has nothing to do with deprivation. It's about ruthlessly auditing what actually brings you joy versus what you are buying simply to medicate the stress of your job or to signal status to other people. When you purchase a larger home that requires you to work an extra decade just to service the mortgage and property taxes, you are not buying comfort. You are buying a highly decorated prison cell. The psychological shift requires you to stop viewing money as a mechanism to purchase objects and start viewing it exclusively as a mechanism to purchase your own autonomy. Every time you reject a socially expected lifestyle upgrade, you are fundamentally buying back a piece of your future timeline. Until you cure the psychological disease of social comparison, no amount of income will ever be enough, and true optionality will remain entirely out of your reach.
We have diagnosed the mathematics of the trap and the psychology that keeps you locked inside it. Now we must pivot from theory to ruthless execution. Insight without action is merely intellectual entertainment, and we are not here to be entertained. We are here to reclaim your autonomy. This is the Strategic Masterclass. I am going to outline the exact, granular blueprint you need to execute, starting this coming Monday morning, to shift your entire financial architecture from a fragile accumulation model to an ironclad optionality model. Step 1 is the Monday morning liquidity audit. You cannot engineer optionality if you do not know your exact baseline survival cost, to the penny. I am not talking about a casual glance at your credit card statement. I mean a forensic, line-by-line examination of your trailing 90-day burn rate. You must separate your mandatory infrastructural costs, housing, baseline groceries, utilities, baseline insurance, from your lifestyle overhead. Most middle-class Americans blend these two categories until they are indistinguishable. You need to identify the exact dollar amount required to simply keep the lights on and your family fed if your active income went to zero tomorrow. To actually execute this shift, you need a precise dashboard measuring cash flow, not just static net worth. I personally use the tracking tool linked in the description below. Setting up a free account takes 10 minutes, and it is a mandatory foundational step for executing this exact strategy. Once you have established that baseline burn rate, step 2 is the systematic extraction of your capital from the Wall Street fee machine. If you are currently employing a traditional financial advisor who is charging you a 1% assets under management fee, Monday morning is the day you make a very uncomfortable but incredibly lucrative phone call. You are going to terminate that relationship. You do not need to be confrontational. You simply instruct them that you are transferring your assets to a self-directed discount brokerage, like a Fidelity, a Vanguard, or a Schwab. You will initiate what is called an ACATS transfer, which moves your holdings in kind without triggering a taxable event. Once the capital is under your direct control, you must ruthlessly audit the internal expense ratios of every mutual fund you own. You are looking for any fund charging more than 0.1%. You are going to strategically liquidate those expensive, actively managed funds and reallocate that capital into broad market, low-cost index funds or exchange-traded funds. We are talking about vehicles like the S&P 500 index or a total stock market fund, where the fee is literally a fraction of a basis point. By executing this single maneuver, you instantly plug a massive leak in your financial hull, reclaiming hundreds of thousands of dollars in future compounded growth that rightfully belongs to your family. Step 3 is the debt annihilation sequence. Remember our definition of optionality. It is the margin between your unearned income and your baseline cost. The fastest, most mathematically guaranteed way to widen that margin is to permanently lower the baseline cost by destroying debt. But we must look at this through the lens of calculated realism, not emotional debt shaming. If you hold a 30-year fixed mortgage locked in at 2.75% from 2021, you do not touch it. That is beautiful, highly subsidized leverage being actively inflated away by the government. Keep it. However, if you are carrying a 7% auto loan or a 9% personal loan, or God forbid a 22% credit card balance, that is a financial state of emergency. Paying off a 7% auto loan is the mathematical equivalent of earning a guaranteed, risk-free, tax-free 7% yield on your money. Try finding a completely risk-free 7% yield anywhere in the modern bond market. It does not exist.
you must redirect every available dollar of free cash flow, every bonus, every tax refund, every dollar saved from canceling subscriptions directly at this toxic consumer debt. Every monthly payment you eliminate permanently reduces your baseline burn rate, instantly increasing your optionality. Step 4 requires a fundamental rewiring of your future capital deployment. You must stop blindly overfunding your tax-deferred retirement accounts. I'm going to introduce a major caveat here. If your corporate employer offers a 401k match, you absolutely contribute exactly enough to capture 100% of that match. That is a guaranteed, instantaneous 100% return on your capital. It's free money, and walking away from it is a mathematical error. But the moment you hit that match threshold, you stop. You do not blindly max out the 401k to the IRS limit simply because a blog post told you to. If you lock all your surplus capital behind a penalty wall that you can't breach until age 59 and a half, you are actively destroying your present-day leverage. Instead, you redirect that surplus capital into a standard taxable brokerage account. Yes, you will pay some capital gains taxes on the dividends, but in exchange for that minor tax drag, you are purchasing ultimate liquidity. If a massive layoff hits, or a localized real estate opportunity presents itself, or you simply reach a breaking point and need to walk away from your career for a year, a heavily funded taxable brokerage account gives you the immediate, penalty-free ammunition to do so. This is how you build the bridge. You are no longer just stacking bricks into a tower you can't enter for 20 years. You are engineering a liquid, accessible, highly efficient treasury that grants you the immediate power of refusal. You are transforming yourself from a highly paid dependent of the corporate system into a financially sovereign individual.
We have audited the math. We have diagnosed the psychological traps. We have laid out the Monday morning execution plan. But to truly cement this paradigm shift, we have to look beyond the immediate tactics and examine the long-term trajectory. We must project this reality check 10, 15, or 20 years into the future. What does your life actually look like in the year 2036 or 2046 if you choose to remain on the traditional accumulation treadmill versus if you aggressively pivot to an optionality framework today? To answer that, we have to talk about a concept that Wall Street completely ignores: biological depreciation. Financial models are beautiful on a spreadsheet because numbers do not age, numbers do not get chronic back pain, and numbers do not experience cognitive fatigue. The traditional retirement model assumes a perfectly linear transfer of utility. It assumes that the millions of dollars you finally unlock at age 65 or 67 will provide the exact same physical and emotional value that they would have provided at age 47. This is quite frankly a biological fallacy. Let us look at a highly realistic nuance. Take Michael, a 55-year-old software architect. He is playing the traditional accumulation game perfectly. He has a massive nest egg building in the background, but he works 60 hours a week in a high-stress, sedentary corporate environment. He tells himself he is doing it for his future, but the silent math of biological depreciation is compounding against him just as fast as his portfolio is growing. By the time Michael hits 65, he might actually hit that $3 million target. But what if his knees can no longer handle the rigorous hiking trips he deferred for 3 decades? What if the systemic stress of his career triggers an autoimmune response or a cardiovascular event? Wall Street will proudly present him with his massive accumulated balance, completely ignoring the fact that he traded his peak physical decades to acquire it. The capital is there, but the physiological capacity to utilize it has been permanently eroded. Optionality solves directly for biological depreciation. When you engineer a life where your baseline expenses are radically low, your toxic consumer debt is zero, and you have liquid, accessible capital outside of government-restricted accounts, you do not have to wait for a state-mandated birthday to step back.
You can choose to downshift your career at age 50. You can pivot to consulting part-time, preserving your health, drastically reducing your cortisol levels, and actually enjoying your physical vitality while you still fiercely possess it. You are literally buying back the healthiest years of your life. That is an asset class that no central bank can print and no wealth manager can offer you. Now, I can already hear the objections forming. You might be saying, but what if the Federal Reserve slashes interest rates back to zero? What if we enter another historic bull market run, and by shifting away from maximum accumulation in tax-deferred accounts, I mathematically miss out on hundreds of thousands of dollars in compounded gains? Let us dismantle that objection with calculated realism. Yes, in a perfect macroeconomic vacuum, maximizing tax-deferred growth in a massive, uninterrupted bull market will absolutely yield a larger gross number on a screen. But you do not live in a perfect vacuum. You live in a highly unpredictable, volatile reality. If the market goes on a massive tear, your liquid brokerage accounts and your debt-free cash flow will still capture significant, life-changing upside. You will still be incredibly comfortable. But if the exact opposite happens, if we face a protracted decade of stagflation or a severe extended market correction, or if you simply lose your corporate income at age 54, the traditional accumulator is instantly trapped in a state of sheer financial paralysis. The optionality strategy provides an asymmetrical return on your peace of mind. It protects your downside baseline perfectly, while still allowing you to capture upside growth. It's the ultimate defensive maneuver in an inherently unstable economic system. I need to be very clear here, because the financial media landscape is filled with charlatans making absolute, guaranteed promises. I'm just a guy on the internet sharing my research and my own mathematical observations. I am not intimately familiar with your specific tax brackets, your family dynamics, or your medical history. You should always consult a fiduciary, specifically a fee-only fiduciary who does not earn hidden commissions by selling you mutual funds, before you execute massive structural changes to your portfolio. But when you sit down in that office, you must ask yourself and your fiduciary the hard questions. Are we optimizing for a gross vanity number on a spreadsheet, or are we actively optimizing for my absolute freedom? We're living through a profound economic transition. The safety nets of the 20th century are completely gone. The corporate loyalty that protected previous generations has been entirely liquidated in the name of shareholder value. The government is managing a sovereign debt burden that will mathematically require higher taxation and continued systematic currency debasement. In this environment, relying on a distant, heavily restricted, speculative pile of accumulation is the most dangerous risk you can possibly take. True wealth in America is no longer defined by the square footage of your primary residence, the imported badge on your vehicle, or the gross vanity metric of your 401k. True wealth is the unassailable, unconditional ability to say the word no. No to the toxic employer. No to the societal pressure to endlessly consume. No to the hidden fees quietly draining your family's legacy. It's the ultimate power to dictate exactly how you spend the rapidly depleting currency of your own mortal time. You have the data. You understand the psychological traps designed to keep you poor. You have the exact Monday morning blueprint. The only remaining variable in this entire equation is your willingness to step off the treadmill, reject the multi-trillion-dollar illusion, and start building actual, tangible leverage. Don't wait for permission from a financial system that strictly profits from your lifetime of compliance. Reclaim your capital, reclaim your timeline, and build your optionality.